That's it. Yeah.
Yep, you can go ahead and.
Yeah. So before we get into this, I'm just going to read it because I wrote it out because um, let me state that a disclaimer to appease my compliance department. Nothing I share is to be deemed as a recommendation of any kind. I'm simply sharing what I do personally and share what I'm sharing with clients every single day. So please remember, there's no tax advice. There's no recommendation here. That only happens one-on-one. Thank you.
Awesome. Thanks, Scott, and welcome everybody. We're happy and really thrilled at the turnout this week. And we have an awesome guest, which kind of flows from last week or 2 weeks ago, I guess, when we interviewed Marty with some private mortgages. This is going to be somewhat related, but kind of different as well at the same time. Yeah, so without further ado, thanks, Scott, again for joining us. Maybe you can tell us a little bit about yourself and your company, MGM Wealth Management.
Awesome. Yeah, well, Greg, thanks, and Amanda, thanks for having me. MGM is a partnership of three. I'm the G in MGM, and we all do similar work and collaborate and share, and we also share staff. But beyond that, we run our own shops. I've been in business for 25 years, and I made a distinct change in approach about 5 years ago. That's made all the difference in everything in my life better. I've been real estate investing as well personally as a wealth building tool for about 8 years now.
Awesome. So I guess to expand a little bit about last week and how we're tying into this week, anybody who knows me and understands a little bit about Jenna and I's investment style will understand that we do feel that a diversified portfolio is really, it's key to building both wealth and assets. But, you know, with our focus kind of being in real estate, can you tell us a little bit about how your products can help investments in the real estate world?
Okay. Well, first is the way I help is to understand it's a process. I happen to have a highly efficient product to facilitate that process, but the initial part of this is understanding the problem is with the flow of your cash. Once I can figure out how to channel your cash in a way that you can build it, position it for on-demand use through leverage. So think of it kind of like a line of credit, but it's much more than that. It's more or less a line of credit on steroids. If you build it up properly, and you know, that's basically like if you design it properly, it can provide, you know, all the benefits of a line of credit beyond that. Of course, you know, actually right in the middle of all this, where we're at now, I was just learning from Leanne that there's banks actually stopping clients even allowed to use lines of credit toward down payments. And the way I do it is it's not, you know, you are using leverage, but it's considered cash when you go to apply.
Oh, wow, really? So like when a bank looks at where the source is coming for your down payment on your investment, they look at your method differently than from a line of credit. So that's really good.
Yeah, absolutely.
Right?
Absolutely.
Because I mean, line of credits aren't bad. A lot of investors will use line of credits that are leveraged from their existing property. So they have the equity there.
Yep.
But, so this is different. So that's great to know. That's awesome. How are you different from other financial advisors? Can you tell us a little bit about, you know, your style and what differentiates you?
Yeah, I guess think the opposite. What I always say is think the opposite. When you think of a financial advisor, you likely think of an asset gatherer. And I was guilty, or I say guilty nowadays, but that's what I did for the first probably, I've been in business 25 years. So I guess 17, 18 years, I was just like everybody else and looking for, you know, where's your money at? How much are you saving? Move it over to me, and I'll put it all into basically prison and hope it works out all right at the end. So I do the opposite now. Instead of putting your money away and hoping, I position it for liquidity, use, and control, which reduces and often eliminates risk. Put another way, rather than planning for the end of working, uh, i.e., putting your money away and hoping that it all works out at the end, instead of just looking at the end, I say, like I like to say that I'm a lifestyle planner, so it's more the here and now versus the waiting and hoping.
Hmm. I really love that term, put your money in prison. I've never really thought, I think of it that way because anytime, an investor will approach me and talk to me about, what should I do? What should I do? I'm sitting on money. Go make it work for you, go make it recreate itself somewhere.
Exactly.
So,
Absolutely.
and I mean, Jenna and I have been guilty in the past of putting our money in prison. So, we see things a little bit differently now. But no, that's a really good. I'll use that again. Have you trademarked that? Am I allowed to use?
Yeah. No, that's a free for use.
That's a free one.
That's what I've been referring to myself as. I've been in this COVID situation too. Is people ask me, I was like, well, I can't complain. I got a pretty big prison cell here that I'm living in. So, the life of an inmate here is not too bad. So.
Yeah. While your money's out there making money.
Exactly.
Yeah. There's one, I call him my wealthy barber. He's a barber in the city. And if anybody wants to know who he is, he always said, you're very successful. You make money when you sleep. As a good.
He understands the process.
He understands the process. Although he probably cuts about 80 heads of hair a day, he's making millions another way.
Yeah. But he's doing that because he wants to. See, he got the passive income to, and so his a good day for him is to talk to 80 different people. So
he loves it. He feeds off of it. Yeah.
Exactly.
Who's your ideal client?
My ideal client is a business owner, at least part-time. They got to be open-minded, coachable, and decisive. That's an imperative for me. Is because what I do is pretty much the opposite of any conventional financial advisor, in that I focus on income versus that putting the money away. It's a mindset shift. So you need to be coachable and kind of, and I'm not saying, when I say decisive, I'm not saying decisive in that just believe me, this will all work. Is when I show you why it works, then be decisive about it.
Yeah.
They're likely between 35 and 55 years old and have a family and are genuinely friendly. I don't like dealing with adversarial people either.
No, you have to have an open mind.
Yeah, for sure.
It's kind of the same thing when I'm dealing with investors as well. We want to make sure that once we do find the scenario that fits all of your check boxes, are you willing to move forward and take action on that? And if you're not, then it's not something that I can help you with. You have to be a little bit coachable and stuff. I mean, we're all guilty of it. That first one, right?
Yeah, for sure. Yeah.
You buy the first real estate. I don't force people to buy products, but when I find the right scenario and I know deep down it's perfect for these people,
right,
I'll give them a little bit of a push. And likewise from you, I imagine it's similar, that if it fits, it fits.
Yeah, exactly. It's and I can deal with no, right? Maybes are killers, right?
Yeah. So. Yeah. How would you say you would help your clients enhance their lifestyle, Scott?
Well, actually, it was funny. We just had a quick chat about the mindset. The first is mindset and control. I show people how to accumulate money safely by avoiding the two biggest wealth destroyers, and those are taxes and lost opportunity. Taxes are the visible one. Everybody knows about taxes, and they are, unfortunately, in our lives, they're our biggest partner, whether we like it or not. The invisible one, though, is lost opportunity, and that is the most devastating one. And for specific reasons, lost opportunity cost, by definition, is when you lose a dollar. You not only lose that dollar, but you lose everything that dollar could have made for you forever. Like this is a lifetime loss, and it just gets bigger and bigger and bigger. So when you take, let's just say you're here's an example here. You're investing in the stock market in March, and then a few weeks later it was down 30%. That 30% is basically, even if you do recover, stay and recover, it's that like that time lost is lost opportunity, and that loss is forever, regardless of your recover. You'll still never get back to where you could have been if you hadn't lost that money.
No, exactly. The returns would have to be compounded and compounded and compounded
Yeah.
in order to return first your initial loss and then get you back on track. Trust me.
And yeah, so in my business, it like, you know, the financial advisor, the traditional, like we have a built-in lie in our world, and that's called average return. And it's because upside returns are always overstated because they're measured from a smaller number, and downside returns are always understated because they're measured from a higher number. So overall, your average return will always look higher than your real return. Like, and the simple example is if you have $10,000 and lose five, you have to make 100. So you lost 50%. You have to make 100% to get back to 10,000.
Hmm.
So that those understated, overstated numbers just it makes it a lie. So it's, you know, when you start really accumulating these things, is why I kind of, it's like I said, when I discovered this process that I used 5 years ago, it was really the first and foremost thing was about it was don't lose money. Like Warren Buffett's 2 rules. Rule number 1, don't lose money. Rule number 2, refer to rule number 1. So.
I love that. Good old Warren.
Yeah. Oh, yeah.
So I guess that's talking a little bit about lifestyle now. What is your goal, I guess, when you're helping a client? What gives you the big win here?
Well, getting people to think about money, think about money differently. You know, teaching them to control and redirect the flow of their cash, help them understand. And this is big: is you finance everything you buy. What do I mean by that? Is you either pay up or give up. And what I mean by that is interest. So if you're using your own cash, we'll go right back to we're in a real estate discussion here. So let's talk a little bit about real estate. So you have a 20% down payment. If that is your own cash, that cash is no longer doing anything. Your property growth in value has absolutely nothing to do with where that cash came from. If it came from your own cash or from someone else's cash, it doesn't matter. It's the same as having a mortgage. Like, why would you not have a mortgage? It doesn't affect the value of the house or the building or whatever you're investing in. The amount of debt attached to it does not matter. So if you can leverage your down payment, your returns are, if you leverage everything, your return is infinite. So understanding that using your own cash means that you can't do something else. Again, that's another opportunity cost, or obviously you're putting it into an opportunity, so it's hard to look at it as an opportunity cost, but it really is. Like if you just attach a value to every dollar you have, whatever that is, 3%, 5%, or whatever, whenever you're using your own money, you are giving up that growth. And again, think of it in terms of what I was just talking about with the loss of an investment. It's the same idea. Like if you're sitting on 100 grand, you need to put 50 into a building. Well, you're not sitting on 100 anymore. You're sitting on 50. If you're able to keep that 100 growing from the 100 and put the 50 into the real estate, then you've created a multiple multiple use for the money. And again, that's a simple thing. That's leverage. And I always say, if you look on my LinkedIn profile, my Francis just distracted me there with his comments.
I'm like a squirrel.
Exactly. Yeah. So, geez, I lost what I said.
No, so I know what you're saying. Your money is tag teaming itself. They're both going. One's going in one direction and one's making you money in the other direction.
Exactly, but they're still earning at the same time. Yeah. So it goes back. So you're still staying on that curve of your capital just continually expanding constantly. And that's really what you want to have. You don't want to give anything back, and you want it to continually expanding.
So I know people's minds are probably a little bit blown and wondering, okay, how does this work? Maybe like we want people to give you a call to talk more in depth so you can give, you know, a full-on explanation, but try and give us a high level explanation of how that actually works. How do you have money here and it goes away, it's being used on an investment here, but yet it's still making money over here?
Okay, so really what it boils down to is it's collateral capacity. Okay, so if you have cash, you know, keep your cash. Even it, like, if, and again, I mean, you know, the first objection a lot of people have with that is, so okay, I have $100,000 in cash in a bank account and I'm getting 0.25% interest on it, or 1% or 2%, whatever it is. Why would I go borrow at 4.5 or 5 when I'm only getting 2 there, and it's taxable? Well, number one is you got to find the right vehicle. And again, that's, you know, I don't want to be cryptic about this. Like, you know, most people in this room actually do know that what the product is, but I use specifically designed life insurance to generate that tax-free growth and leverageability. But again, we'll get into that a little bit at the end. So I'll give you a good lowdown as to how all that works toward the end. But really what it all amounts to is your ability to not use your own money, even if you have it. Like, we're talking about accumulating capital, but it's being used in 2 different ways. Okay, so you got to keep it growing at the same time that it's making, like, again, like if you're getting 3 or 5% or whatever on your cash, and you know, obviously that's a great return on cash. But understand that that's where you're going to have that kind of lifetime growth or never give anything back. You need to be able to kind of use that in other ways. So that needs to stay working all the time. Again, when you take it out, put it into real estate or whatever you're doing, you're taking away that growth. Like, you know, it's like anything. Like compound interest is that snowball effect, right? Again, you got 100,000 growing or 50,000 growing. Well, you know, if you have that collateral capacity, keep the 100 growing. Don't use the 50 in the building if you don't have to.
Keep the 100 growing while you have the 50 working for you. It's genius.
Exactly. Yep.
Yeah. It's kind of the reason why I tie these two together, you know, because of private mortgages blew my mind when I first started learning about how I could help people. And actually, you know, it's a really good return on your investment. So, so this is another product like that. And at first I need to be explained a few times. You know, I need a few times. I need to see it. I need to see the drawings of it. And then, so this is great. You know, every time I hear you talk about it a little bit more, I start to understand a little bit more. I hope all the people listening to are starting to get it. But if not, you can check out Scott.
Yeah, in case I forget at the end too, as I'm an open book. Anybody that wants to talk individually on it, you know, no obligation. I'll give you the full goods of how it works.
Mm-hmm. Speaking of that, if you can give one good piece of advice to our audience to think differently about their money, what would it be?
Start thinking like a bank. Nice. Study and gain clear understanding of how banks make money. 2 words to remember are control and velocity. Banks don't invest money; they move money. Money flow. If you keep cycling your money, you're going to expand your wealth. Think like a bank.
That's great. That's great. I like that. Christina, in your office, on your team, how does she help your clients as a cash flow specialist?
Yeah, so Christina, she's not Christina Wyatt is her name, and she's a certified cash flow specialist. So we, my partners, we put her through the course there about 3 or 4 years ago, and it is a certification course where you know, she gets really into the weeds, so to speak, a lot better than I can, and she helps clients gain perspective of where they're at, and then able to make specific changes to help them move forward. And the key is to help them to move forward into you know, basically unwinding from whatever's stripping them or their money of their cash flow or causing them to waste cash flow. Bring that efficiency to it and do it as fast as possible, because as soon as they can gain control of their cash flow, they're off to the races, and they walk across the hall to my office. Right?
Yeah, that's such a great point, right? Because as investors and entrepreneurs, we're always thinking of where we're going. We're
Mhm.
always thinking about what we want, but we don't often sit down to think, where are we at?
Where you at? Exactly.
You know,
Exactly.
and what's going to allow you to like it's a really important thing to stop and look at that. I mean, Jenna and I, as we grow and our company grows, you know, sometimes we also forget, where are we at right now? We have these big goals and these big things that we're working towards, but sitting down and acknowledging where we're at, and that means with our financial advisors, with our bankers, with all of those people, so everybody knows where we're at. That's really great.
Yeah, for sure. And yeah, so just to piggyback on that a little bit, just to let like what she does is a real like it especially busy people. It's funny, you think the busier people, the more successful people don't need it. They probably need it more because they don't have time to. They may be able to afford because they have good cash flow. Doesn't mean they're being efficient with their cash flow. So a cash flow plan is not, it's not a budget. Like I hate using the word budget. It is a, like we call it a spending plan. Okay. And really all it is understanding where the money's going. Like it's like say, I run into people all the time that have lots of cash flow. And then at the end of at the end of the process, on average, when we go through this process, we find anywhere from, upwards to $3,000 a month. People have no idea where it's going.
Wow.
Yeah, I mean, it's, on average, probably about 12 or 13 or 1400, but it hits 3,000, not on an irregular basis.
Yeah, I mean, a lot of entrepreneurs and busy people and people who are making
Yeah,
pretty good money are focused on making the money.
making money, exactly.
They're not monitoring where it's going.
Exactly.
That's great. This is a specific question that came in about the insurance policy and how much of the money. The question is, how much of the money you invest in the life insurance policy can you borrow and use towards real estate? Is it the full 100%? And how long do you need to have it invested before you can borrow it?
Yeah. Okay. So obviously this is a multi-part question.
Yeah,
So I'll start. So it's a bit of a loaded question. So I'll start with um, the word invest. I always stop people. We're not investing here. The money that goes into life insurance is more like a savings account. Okay. And I say, like, you can call a savings account investing, but in my world, investing is taking risk. We're not taking risk with this. Okay. So the accumulation is risk free. You're using you're basically just using the benefits of the contract efficiently. Why? Because they're tax exempt, and you'll average anywhere from 300 to 800% more interest than a typical savings account. And like, I know that sounds, what, 800% more? It's not, like, obviously not 800% return, but when you think about getting about 1/4% in a savings account, if you're lucky, if you ask for it, because if you don't ask for it, you don't get anything. Um, you could be upwards of 800% better in a typical well-structured life insurance policy. And again, it's tax free. Like even if you're lucky to be getting 2.5 or 3% in your savings account, which nobody is right now, but if you were, it's still taxable. And this is tax exempt. Okay, and again, this goes back to what I was talking about earlier too. Again, it's tax free, but more importantly, you're building, when you're building this, you're building collateral capacity. I was talking about that earlier about your savings account. It's a savings account that you're building, and you can leverage this. You can leverage bonds, you can leverage savings account. Bonds are a risk. People don't think they are, but they are. Stocks are a risk. Like you can leverage those things, but you're always at risk of, number one, of that collateral falling in value, but also your ability to borrow is very much diminished. You can only, like with stocks, you can probably leverage about 50% of it if you're lucky, and
yeah,
and again, you're still at risk if something goes wrong. Yeah, so that brings me to the next part. So you can access up to 90% on demand and unstructured, and that's key too. On demand, unstructured. What that means is you're not required to make any payments, and there's nobody telling you when you have to pay it back. These types of loans are like, see, it's a very unique situation because the insurance company is the policy provider. So they're also they're the lender and the guarantor. So they don't need an application. Doesn't come up in your credit report. There's nothing like that. It's on demand, unstructured. So you have this ability to say, call it up like a bank account, say, Scott, I need 50 grand. Okay, where do you want it? Same bank account, you know, you use for everything else. Okay, whatever. And the only other question we might ask is do you want to set up a repayment plan on the loan? And understand that, and this is where people get a little caught in the weeds too, is when I say it is a loan, you're not borrowing your own money, you're borrowing the insurance company's money. So that's why your money's still that 100 grand, and we've been talking about earlier, if you're borrowing 50 and that 100, that's why it still grows from 100, because you're not borrowing your own money. If you could withdraw it, but then you go down to 50. That's defeating the purpose. What you want to do is create that multiple asset, or that multiple asset use. So you borrow it, you pay an interest rate for it because you're borrowing from the insurance company, not you. But again, it's unstructured. Why? Because they're the lender and the guarantor.
So that means it wouldn't go against your debt ratios.
Nope, not at all.
So
It's cash.
If you're leveraging your own cash, because every time somebody takes out, let's say 50,000 on a line of credit, that affects their total debt ratio and their borrowing power in the future.
Exactly.
So this doesn't affect that whatsoever. You could have $1 million in there and have it all have whatever percentage you can have leveraged, and the bank, if you needed something from the bank, they wouldn't be none the wiser.
So that goes back to what we were talking about earlier about how I said about so when you borrow, it's not a I lost where I was going with that. Hang on, that's my ADD kicking in. Somebody say something. Squirrel. This is
so debt ratio. Basically, we're talking about debt ratio and how you borrow it, and
So when you going back to when I said it's like cash, like if you give it to a lender, a statement from your insurance policy, that's cash. It's not and it doesn't matter that you borrow it, because number one is you have the ability to withdraw it if you wanted to. So it is considered cash to a lender. Like I just Tammy and I just signed a deal on a duplex last weekend, and the first thing that was asked for is we need to show that we have the down payment. I sent them a life insurance statement. Perfect. For my down payment.
So not only does that not affect your lending power, but correct me if I'm wrong, it's an asset as well. So it actually
absolutely.
So it's helping you in two ways. It's not affecting your total debt ratio service, and it's also providing you more financial backing.
Exactly.
Great.
So I mean, it's just a great, like, I mean, this is why, I mean, I slid right into this. I started investing in real estate before I even realized, like, I mean, the real long story of this is I started in the life insurance business in 1994, and I didn't know until 5 years ago that when you borrowed money out of from a life insurance contract, that it didn't actually lower the balance. So I was ill trained. It took me about $60,000 and traveling around the continent for 2 years to kind of figure out that, that's a multi-use asset. So don't even get me going on the training I had back in '94, because if I'd known that, where would I be now? I don't know. But anyway, but that's another story. So,
well, thank you for doing that for us. We appreciate getting informed so you can inform us.
So the real estate aspect of it was it was funny, because I started investing in real estate, and then 3 or 4 years into this, I'm like, wow, there's a product in my arsenal I didn't even know about that marries to it perfectly. Why? Mm-hmm. Because they do the similar things. Okay, so the thing we understand is this thing has long-term value in a tax-exempt basis. You'll never pay tax on it, but it also has short-term usage. So and I said the only thing that possibly sits well beside it is rental real estate, because rental real estate, what it is, it's passive income that goes up with inflation. So you can actually, if you want to hold your real estate forever, then you don't have to worry about running out of money like the other 95% of people that have a bunch of money in RSPs and investments that are just hoping that they don't run out of money. That doesn't happen with a passive income. No, I mean, not that real estate investing isn't without risk. Obviously, it is. I mean, but the fact is if you understand rental real estate, you make your money on the way in, and if you know where the cash flow is coming from, it's only going to get better with time because you're going to pay down your debt. You're going to, all these, all the things that many of the people in this room already know, of the benefits of real estate, and the life insurance beside it actually marries to it perfectly because it has the short-term benefits, it has the long-term benefits, it produces passive income on demand.
That's fantastic. It's making a bunch of little soldiers go out there and work for you all at once. Great. Did you have, I thought you might have had a few things you wanted to share at the end here. Was it a few slides?
Well, I could. I was kind of waiting. We can kind of open it up to questions. Oh, actually, one thing. I don't think I finished answering about when you can use the money.
Yes, the last part of that question.
Yeah, I did. I don't think I mentioned that. So that's that part of it's a really loaded question because it's depends on the structure and the supplier. Okay, so obviously I don't work for one specific insurance company. I am a independent advisor, whatever you want, how you want to deem that. So there are different, like there's lots of companies that provide an adequate product to do it. They all have similar, but they are different rules. So I can answer this as the best case is if you max out the structure of the product for usage immediately you can have access to 50% of it. And on the worst case is you can't touch it for a year. So I guess that's and there's all kinds of other variations and permutations in between. So if you're and like I've used before as a typical case I work on would be about a $20,000 annual deposit. So if structured properly, you should be able to reaccess about 50% of that literally the day after you make the first deposit. And in the worst case scenario is there will be value there, but you won't be able to access it until the 366th day.
Right. And does that
it just depends on the supplier's role on that.
Does that percentage ever go up or down?
Oh yeah, it's it'll become like structured properly within three. Depending on your age, actually, the younger you are, the harder it is to get to this point. Believe it or not, but the structured properly, you're over 100% of your money. So your net available is over 100%, usually wow. between year 3 and 5.
Wow. So you're telling me that you can borrow more money than you have in the policy?
Oh yeah, because it gains interest, right? Sorry, not more than that's in the policy, but more than what you've deposited.
Because
so because of what it gains in value, right? But it's always 90% of whatever the cash is.
Okay.
That and I mean there's even more weeds going on here too, because once you get to you can actually get to 100%, but in order to do that, you'd have to assign it to and this is the silly part. You'd have to assign it to a bank, which also brings on now all of a sudden you got to apply for a loan. You got the collateral, it's no problem. You got banks, they're panting at the door waiting to have these products available to them because they know that they're guaranteed. So it's easy to get, but you still got to apply for it, and it comes with terms. You got to at least make the interest payment, because you can borrow 100% of it. You have to make interest payments. Mm-hmm. So that's the other part of why the 90% effect is when you borrow from the insurance company, is because there's no terms attached.
Right, but I mean, if you're borrowing 90% and the 100% of it is still making money, it's better than any interest you'll ever pay at the bank.
Yeah, exactly. So actually, I'll give you a little scenario. So in a typical scenario, like let's just go with 1 year. Like properly structured, what I would put together is if it was about 75% would be available at the end of year 1, 50% right away, 75% at the end of year 1. Okay. Mm-hmm. So and people, the first objection I usually get with people, if you put 20 grand in, it's like I'm out $5,000. And I would argue that you're not. You're actually up 15, or sorry, not well. You're up about 10 because you got 15 working for you plus 90% of the other 15 available to you. So
That's right.
what you've done is taken your 20 and given yourself whatever, say 28 grand available or working.
And throughout that year, that money is making interest on itself the whole time.
And it's still growing the whole time.
It's still growing the whole time. And I'll let you, like, when people contact you directly, you talk about rates and stuff and typical
Yeah,
rates.
for sure. Yeah, absolutely.
Yeah, that's what I want to talk offline, you and I, about next. Because I mean, as you know, I do a lot of private mortgages, and I think they're a fantastic vehicle. But now you're just giving them some steroids there, so you're able to make that money have another avenue to make a return on itself. So
exactly.
And that's how it ties into real estate really nicely. Like you said, you have a lot of different ways of gaining passive income from real estate. Why not find another point of leverage for your hard-earned money?
Yeah, and then that's what I say. Like a lot of people kind of cringe at leverage, but it's really it's about the safest leverage you can have because the collateral is growing at the same time, right? So it's I mean the risk is whatever you put it in. If you're smart enough with real estate, then it's like I said, you either eliminate or tremendously mitigate the risk.
Awesome. So if I wanted to lend out, for example, let's just use some even numbers, 100 or 25, 50,000 or no,
Sure.
25,000.
Okay.
Sorry, numbers are jumping around in my head right now. So if I gave you $50,000 tomorrow to invest in that, I could get that 25,000 back out and loan that money, create that interest while the whole 50,000 is earning an interest.
Yep, exactly. Yeah. So if you had 50, and it's like I said, so yeah, structure. If you put in if you did a $50,000 deposit again, and it's got to be the right company that allows you to access a portion. And again, I'm getting into the weeds here of the or is it the how the engine's built as opposed to how the car drives. Yeah. But yeah, so if you use the right if you use a specific supplier, then you could access about 50% of it, like literally the day after you put it in.
I won't hold you to it, but I just email transferred you the money so I could borrow it. No, just kidding. All right.
I'm gonna say somehow it didn't arrive.
On delivery. Maybe we can open things up here to have some questions from our participants. Feel free to bring your camera on if you want to come on. Amanda, if you want to open that up and let anybody. Hi, Amanda.
Hi, back. We did have a question here, but I think it may have been answered, not sure. Someone had asked, how long do you need to have a life insurance policy?
How long, like in place before you use it? Was that about like if whoever asked the question, if you want to just can you unmute them and they can clarify the question?
Yeah, it was me. Sorry. Great stuff, Scott. I mean, from the beginning, I kind of stopped listening because it was exactly what I wanted to hear for a long time because
I thought I was putting you to sleep.
A couple of financial. No, it was great. Trust me, it was great. I was like, this is what I was. I felt like I'm in the right place at the right time. I just feel lucky today because usually this is my first kind of meeting with the folks and all that. I just stumbled upon the meeting link. I was like, okay, let me join this. Sure. I've met with a couple of financial advisors, right? And they keep telling me things that I don't really like to hear, which is how to save your money till you're kind of old. I'm like, I've worked in the bank. I worked in the bank for about 5 years, and I'm like, I don't kind of like the idea of saving because I'm making it and then I'm stashing it. I don't kind of see it doesn't work for me. I don't like that strategy. Anyways, so when you started to talk about financial advice, I was like, okay. So when you started talking about wealth creation, I was like, yes, that's what I want to hear. I want to hear how I can make the money now and how I can reinvest it now. Yeah. So if I'm going to go straight to a question right now, I'm going to ask do you have, I understand you mentioned the kind of your ideal client, but do they have a typical wealth class? Like, do you need to have a certain amount of money or do you need to have a certain amount of leverage or what is it that has to work?
Yeah. So to answer the question, yes and no. It's definitely scalable. Up and down from like I said, like a typical initial plan that I would do would be like a $20,000 annual deposit. I can do, but I've done them for as little as, starting as little as $1,000, $2,000 to start. Again, but you're going to get what you put into it. And it's kind of funny. I use this term a fair bit with people too, is a lot of people get hung up in the dollars, thinking that, like most insurance shoppers, if you will, is how much does it cost? And it's not, but it's not that. You're asking the wrong question. The question is, how much can I put in? Because the more you put in, the more you'll get out of it. Yeah, you can start with $1,000 or $2,000 or $3,000 a year. But again, it's all relative to how much use you want to get out of it. If you want to be able to use 20 or 30,000 inside of the next 2 or 3 years, then $2,000 or $3,000 isn't going to do it. Does that make sense?
Yes. So I mean, I do need to talk to you after this meeting. I've got lots of. I mean, it looks like we're a very, very perfect fit. So I just keep it there because I've got many ideas that I think we're on the same page on.
Perfect. No, I'm sure I'll probably, send I guess put my email in the chat box or something that anybody can reach me, and phone number and that sort of thing. Yeah, absolutely.
Thanks.
Anyone else?
We have any other questions out there? Yeah, maybe Scott, if we'll maybe wait one more minute, but if you want to, in the meantime, if you want to share your contact details and how people can reach you, do you have like an Instagram account or anything?
Do you see the color of this hair?
So what's the best way for people to reach you,
Yeah,
Scott?
so the best way is probably email, scott@mgmwealth.com. And or call or just call or text me 902-478-2620.
Awesome.
2620.
When we put this up on the website, we'll have all those details when we put the video up on the Halifax Real Estate Investors website for everybody to see. And I'm sure if you have any questions directly that you want to ask to Scott, you can find them at those details.
Awesome.
Awesome. Well, man,
Scott,
thanks a lot. Oh.
So when can I call you, Scott? Can I call you midnight?
You can. I don't know if I'll answer, but
No, I don't have that much money to call you at midnight.
Yeah, no, I can. Just whatever, text or email me and or call or whatever, and we'll set up a time to virtual chat, I guess, at this point.
Jenna's asking if you have a spreadsheet that you would like to share quickly.
Well, I can do that.
Not
I
to
can
put you
do
on the spot or anything.
yeah, no problem. I can bring up basically what I did in our networking group last week, and I'll bring up like I have this real estate analysis calculator. Probably no one on here has probably ever seen before, except for the people that were on my thing last week. And I can bring up and I just use a kind of a typical scenario. So I do have sharing ability at the moment, do I?
I believe you do. Yeah. We have a few extra minutes, so why don't we take a look at that?
Sure.
That'd be great.
Host disabled participant screen sharing. Okay.
Amanda. Yeah, let's see here. There's the awkward silence.
Yeah, it says we can share.
Okay, well, I'll try it again. Hang on. No, host disabled.
Share. Okay, try now.
Yep. We're good.
Got it now?
Yeah, we're in.
Good
Okay.
Good stuff.
Do we have? What am I? You know what? I might be sharing a little too much here. Can you guys see that screen?
Too late. I already got a screenshot of it.
Yeah, we can see it.
No, I say so you can see the calculator. Yeah, I'll just to keep this simple. Share that. I did that right. So you can see the calculator now. Okay.
Yeah,
so Yeah, so this is basically what I'd almost say like a typical real estate scenario where you have a property worth $250,000, you have $7,500 closing costs. Again, I'll back up here, and this is in three separate sections, right? There's property information, expenses, and investment analysis. So the property information is 250, so 257.5 all in. Ignore the numbers below that. That's for depreciation. I left the taxes out of this just for simplicity. So if you had a typical conventional loan of 20% down, you'd have a loan amount of 200,000. I used a 3% interest rate for 30 years. You have $843 mortgage payment, and I just lumped one number here in the middle for the expenses of $800, $2,000 monthly rental income. So you're in that close to that. I don't know if anyone's ever heard of the 40-40-20 rule. 40% financing, 40% for expenses, 20% for profit. This is close, not quite there, but it's close. So once you go through that, and again, I mean, this is obviously just a lump sum for the example, because the investment analysis is really where this thing starts to change. So I did it over 60 months with an average appreciation of 3%, down payment of 57.5, cash flow of $357 a month. That would work out to 7.45% cash on cash return. And overall return based on your principal reduction, your cash out in 60 months, you'd have a 21-ish return. So how can we enhance that with the use of other people's money? Okay, so just like now, and again, I'm going to show you this first, just like anything else is, okay, so if you had a line of credit that charged you 5%, you could do this. If, of course, if the bank would allow you to use the line of credit, but let's just say you can, just like any other line of credit, you would have all of a sudden you jump your return from 21 to 62% just by using $50,000 of someone else's money. So now you're only into the deal for 7,500. Your cash flow is taking quite a hit, but the cash on cash return is better. I can't remember what that number is. Give me a second here. 7,500. So your cash on cash is just under 24% in that scenario. You only got $7,500 in the deal. And why would you want to do something like this? Reduce your cash, obviously. If you can, if you can duplicate that 5 or 6 times, because you only got $7,500 involved instead of 57.5, then you're going to be able to expand your wealth. But here's where it gets cool with the life insurance. And this kind of goes back to when I said it was like a line of credit on steroids, is if you're in this thing with $50,000, and let's just say you're getting, generally what these policies will produce structured properly is anywhere from 3 to 5% tax-free over the lifetime of the contract. So let's call that 4. Well, 4%, but it's also tax-free. This 5 is tax deductible because you're investing. So take 40% off, you're down to 3% anyway, or even 50%. Like basically this interest is going to cost you after tax less than the interest you're making in the insurance policy. This program won't allow me to go to negative. If I just throw 0 in here, you expand your return even further. I'm sure lots of people in this room could wrap their arms around an 83% return. So that is what all you've done there is said, okay, I got a really good investment that's making me 20%, and I just quadrupled it. Make sense?
Yeah, that's amazing.
So that is the essence of using what's already a good store of value and allowing it to enhance your other business as well.
Excellent. So does anybody have any questions while Scott has this analysis up here? I mean, I'm sure there's going to be a lot of people asking questions after the webinar, but is there Anybody have any other questions regarding that?
There's a few in this room that have seen this literally in the last couple of days. So
A lot of us are just seeing it. I've only
Yeah.
seen it for the first time, so it's definitely mind blowing quite a bit.
yeah, so it's like I say, once I guess latched onto it, it was the pure truth. It was my life. My life got a whole lot better and just a lot less stressful 5 years ago when I just started doing this instead of wondering where how I'm going to make sure that people don't lose money.
Would you consider yourself risk adverse?
Yeah, absolutely. Yeah, 20, I go back and talk a little bit about my history in this. Like, I came in the financial service business like everybody else. Like I was going to become some investment jockey or superstar. And for the first 5 years, I was a genius. I mean, the markets were 20+% every single year I was in business for the first 5. And then 2001, 2002 happened. And and suddenly I was like, okay, that's so all those gains are gone. And then of course, coming out of 2002, the conversations I was having with people is that kind of a decline happens once in a generation. Well, apparently generations are only 6 years long now. Because 2008, it happened all over again. Another 50% drop in the stock market. So needless to say, that after 6 years of gut wrenching, where basically I was what's the word I'm looking for? Yeah, so the 2000s were pretty stressful for me, put it that way. When markets go down 50% twice in the same decade, it's you grow a pretty thick skin, that's for sure.
Yeah, it's funny because both you and Marty, having interviewed him a couple of weeks, 2 guys with some really amazing investment vehicles, and both of you are risk adverse. You do not like taking risks.
No, and again, the biggest part of risk, like, or what I love about this, and what I by design hate about the stock market, is control. This, you're fully in control. You put your money in the stock market and hope it grows. That's really all you're doing. You're hoping, because you're completely out of control. I mean, I can bring something to the table because I've been kicking around for 25 years, but I can't control what the masses do.
No. It's almost like it's a method that the wealthy use. And
interesting you said that. That's, if you looked at my LinkedIn profile, that's what I say. Like, I help people enhance their wealth using strategies of the wealthiest 1%. Yeah. See, the wealthiest 1% don't use their own money. They always keep their own money safe and use other people's money to make more money.
That's great. Goodness, that's a fantastic way to lead this call off. So thanks a lot, Scott, for joining us and providing some fantastic insight.
Oh, thank you very much for having me. I appreciate it. I had a great time.
Yeah. So everybody out there, if you don't have any other questions, we're going to wrap it up for tonight. But stand by. We're going to move these to bi-weekly meetings. So we're going to have an announcement probably early next week on who our next guest is. But today was really awesome. I've learned a lot. I hope you guys have learned a lot. I hope we're able to provide you guys some value. And yeah, thanks again, Scott.
Thank you. Thank you. Thanks everybody for coming. Appreciate it.
All right. Good night, everyone.
Good night.